The Fed has finally announced that it is time to start cutting interest rates. But what does this mean for the stock market? Will it go to the moon? Or chibabu and crash 18 levels underground? That's why in this video, we'll be looking at past historical data to see how the stock market typically performs after a rate cut. Not just that, given that there's a possibility that a recession may come soon, I will also share how you should be investing during this period. But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. So, according to the Fed Watch tool, the market is now expecting a 25 basis points cut in September, a 25 basis points cut in November, and another 25 in December, which means the market expects interest rates to come down to the 4.25% range right before Christmas time. Ho ho ho. Interestingly, this is a little more bullish than the Fed's original projection in June, which only expected to cut rates till 4.75%. But given that there's a possibility that the recession might come soon, there's a high chance that the Fed will revise their projection downwards in September to indicate that they'll be cutting rates a little more aggressively. So, what does this mean for the stock market? I'm sure many of you have seen this chart, where it seems like every time the Fed cuts rates, the market will crash hard. However, this is not the full picture because there are times where the stock market has gone up even when the Fed had cut rates, like in 1980, 1984, and 1987. So, what's going on? The answer is simple. That's because there are two reasons that the Fed wants to cut rates. The first reason is because they've succeeded in bringing the inflation down. So, there's no longer a need to keep rates high and they start to cut rates. Then, the second reason is because the high interest rates itself is hurting the economy. So, the Fed wants to cut rates in order to save the economy. For example, in 1981, the Fed was fighting a huge inflation and they lowered rates when the economy entered into a recession. Same for 2001 as well as 2007, where the Fed lowered rates to save the economy from a recession. So, the key word here is recession here. We can see that if the economy enters into a recession after the Fed's first rate cut, on average, the market tends to fall by at least 10%. But if there's no recession after the first rate cut, the markets will start going to the moon. Hola! So, will we enter into a recession? Unfortunately, there are increasing signs that the US economy might enter into a recession. Here's why. 1. The unemployment rate has recently gone up to 4.3%. While this number is still relatively low, this rise in unemployment rate has managed to trigger an indicator called the sum rule, which shows that if the 3-month moving average of the unemployment rate rises by 0.5% above the low from any point in the previous 12 months, a recession has always managed to happen. Though, according to the inventor of this rule, Claudia Sum, she feels that just because this indicator has been triggered, it doesn't mean much. Instead, we will need to rely on more data before deciding whether a recession will come or not. So let's look at another data, the job growth data. Here, we can see that the job growth has been trending downwards, which may further add to the risk that a recession may happen. But what about the GDP growth rates? Didn't the GDP grow at 2.8% in the second quarter? Yes, but according to the estimates by GDP Atlanta, the latest GDP growth forecast has now gone down to 2%. Which again means the economy is slowing down. Also, due to the inflation rates being so high for so long, US consumers are increasingly being forced to spend more. As a result, their savings rates has been slowly declining, while some are turning to using credit cards to pay for their expenses, causing the total credit card debts to reach another all-time high. This is super bad, because if you had to rely on credit cards to pay for your expenses, you might end up being unable to repay the debt and will in turn incur even more debt through those high interest fees and late payment fees. Here, when we look at delinquencies across all kinds of loans, meaning which are the ones that the consumer are unable to repay the loan, the one that's increasing the most is credit card debts. Meanwhile, delinquencies on things like mortgages, car loans, and student loans all remain relatively low. So, when you have the labor market slowing down, GDP growth rate slowing down, consumer spending going down, all while being unable to afford their living expenses, is starting to look a little like recession, nah? Oh. So, does this mean that there will be a crash soon? Maybe, maybe not. I don't know. But what we do know is that there will be a lot of volatility during this period. That's because first, this year is an election year, and the market tends to swing wildly during election years, especially around the August to November period. And right now, given that both candidates have almost the same odds of winning, there's a lot of uncertainty in the air, which the market does not like. Second, there's war going on in some parts of the world, like the Russia-Ukraine war, where Ukraine has actually started invading Russia, and in return, Russia launches even more missiles back at Ukraine. And in the Middle East, Israel and Hezbollah are fighting against each other. Though sometimes I just wish that these leaders would just sit down and settle their dispute by fighting each other on Street Fighter and Dance Dance Revolution. Meanwhile, the Bank of Japan is also planning to continue raising interest rates, which may further unwind the yen carry trade, which, as you may recall, this caused the US stock market to temporarily drop earlier this month. So what does all this mean for you as an investor? The most important thing that you should never do is to panic sell whenever you see the market drop. That's because even in a year where the market ended green, it can still see huge drawdowns, like in 1998, 1999, and 2003. And the problem with panic selling is that the best days in the market tends to happen right after the worst days. As a result, you will significantly reduce your profits. Not just that, even if a recession did come, the market has on average given 7% return within 6 months, and subsequently went on to go up a lot higher. So rather than panic selling, here are some of the things that you can do. 1. Don't stop dollar cost averaging into the market, because if you stop investing and the crash did not come, you will end up FOMOing in at an even higher price. 2. Start preparing money on the sidelines. In fact, you can keep the money in the broker itself, as many brokers will auto-sweep your money into money market funds to let you earn around 3 to 5% return. Then, the moment you see a crash, you'll be like, "Baya!" and start buying the dip. As to how you can exactly buy the dip, if you are investing in ETFs, it's simple. You want to be buying in at support and resistance levels. For example, for the S&P 500, $523 would be a good price to buy in, followed by $495, then $482. In fact, if you have sufficient buying power, you can even consider selling puts at these levels to collect some premiums while waiting to buy in. And speaking of options, you can check out the sponsor of today's video, Moomoo Singapore. Moomoo Singapore not only offers free real-life pricing with 60 levels of market data, but also allows you to quickly select a combination of options strategy while supporting a one-click view of the profit and loss chart, so that you can easily know what's your break-even point, maximum profit, and maximum loss. Moomoo Singapore has one of the cheapest options fee out there, and with their latest tiered pricing plan, you will get to enjoy even lower options trading fees the more you trade. In Moomoo Singapore's latest welcome promotion, you will get to earn up to 1,034 Singapore dollars worth of welcome rewards. This includes a 6.8% per annum guaranteed returns for up to 30 days on your first 80,000 Singapore dollars invested with Moomoo Cash Plus. Up to 4 stock bundles of the top 5 traded US stocks worth $70 each, and an Apple share worth 287 Singapore dollars, plus up to 20 Singapore dollars cash coupon exclusive reward when you sign up using my link. Holding period and buy trades apply. So if you are interested in taking your investments to the next level, do try out Moomoo Singapore. And with that being said, let's get back to the video. Likewise, for stocks, you can also use the same strategy where you buy in at support and resistance levels. On top of that, the closer you can buy into the intrinsic value, the better. For example, according to Guru Focus, the fair value of Nvidia is at $60, whereas FinChat thinks it's closer to $77. Now, given that Nvidia is currently trading at $120+ and everything looks sui-sui, it's probably unthinkable to even see it drop by that much. But didn't we just hit $90 earlier this month and $77 just 3 months ago? So it's certainly possible for the stock to fall by this much, yeah. But let's say you really want to time the market to profit off this recession. What can you do? In this case, you can invest in sectors that do well during a recession. So it was found that when a recession comes, consumer staples, utilities, and healthcare perform the best as compared to other sectors, whereas sectors like real estate and technology perform the worst. So if you are someone who's investing in technology stocks or even REITs, you may want to be a bit careful, yeah. Then when the economy starts to recover, the best sectors to be in are real estate, consumer discretionary, and materials. Though, if you are just lazy and want to invest in all the best growth stocks, one simple way is to invest in SKVFQ and be done with it. Now, besides investments, if you are still parking a ton of money into high-interest savings accounts like UOB, OCBC, and money market funds, you may want to start moving some of your short to mid-term savings into SSB to lock in the high yields. Yes, I know that it's possible to get up to 4+% interest in some of these accounts, and SSB's 3+% interest may seem low. But given that interest rates are about to come down soon, it's definitely better to lock in the 3% rates for 10 years, rather than hold the money somewhere else and pray that the rates won't come down, which it will eventually will. Anyway, that's all for this video. Hopefully, you found it useful. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.